Year-over-year core PCE coming in slightly higher than expected in June ahead of a big decision on rates next week, though it was mostly in line and showed a lot of progress. Traders sticking to the view that the Fed will cut rates in September. Here to break things down is Apollo Global Management Chief Economist Torsten Slok. Another sign of progress on the inflation front. Does this cement the view that they will start hinting at September next week?
Well, as you're saying, Sarah, today it was actually the case that core inflation was a little bit higher, and that's also what we got in the GDP report yesterday. So combining that with the overall GDP headline of 2.8% growth, strong jobless claims yesterday. We also got retail sales for June still strong. If you look at the hotel demand on a weekly basis, still strong. TSA data also strong. Across the board, you're still seeing reasonably strong growth in the economy. Yes, there are some pockets of weakness, and we're certainly all watching that very carefully. But I do think that the main message from the data we've gotten this week is still that the economy is doing quite well. Inflation is coming down, but it's just not coming down as quickly as everyone would like. And finally, we have two more CPI prints before the September 18 FOMC meeting. So yes, the Fed may cut in September, but let's just wait and see a little bit more progress on the inflation front, just exactly as Jay Powell has been saying.
So you are not convinced? I mean, it was a pretty core PCE, and we're going to do decimal points here because 0.182% was the monthly change. I mean, that's okay. And even with the May revision higher, we're not talking about any kind of flare-ups of inflation like we saw in Q1. And Torsten, incomes were lower than expected and spending was lower than expected.
Understood, but the tailwinds coming from the gains in the stock market. The S&P is up more than 10 trillion since the Fed decided to talk about cuts in November of last year. That tailwind to consumer spending is the whole reason why we're still seeing strength in hotels, airlines, restaurants, concerts, sporting events. Across the board, it's not surprising that consumers are doing so well, despite that the Fed has hiked. Yes, I know everyone wants this cut to come, and sooner rather than later, because, yes, it does make sense from a number of different dimensions to begin to maybe normalize interest rates. But at the end of the day, if the strength of the economy is still running the risk here that we might get another, as you're saying, flare-up or more tailwind to the economic outlook, then I do think it's premature to take out the champagne bottle and begin to talk about a dramatic amount of rate cuts coming.
Just because the stock market is going up? I mean, you think that's the biggest upside risk? That's going to happen anytime they go into a rate cut. If you look at some of the labor market measures, the fact that unemployment has gone up to 4.1%, and I get it, it's still decent, but we're seeing a move up. The job openings picture, the openings ratio to unemployed people, the unfilled jobs to unemployed. I mean, all of those point to cooling in the labor market, which is something the Fed, it's part of their mandate, and they have to prevent it getting worse.
I hear you, Sarah, but hold on. Non-farm payrolls was 206,000 last month. The consensus expects also 200,000 for July. It was 200,000 12 months ago. Job creation has basically been flat for the last 12 months. So in that sense, we're still seeing steady job growth. Some of that is likely immigration, and immigration is likely also the reason why the unemployment rate has gone up. We're not seeing layoffs go up. We're seeing people show up at the labor market and looking for jobs, and therefore job growth is still steady. But you're right, there's some weakness in some of the labor market indicators, but the question is, does that justify the pricing of 3 cuts this year? And I don't think that's the case. I still think that the economy is doing quite well. Yes, there are some signs of weakness here and there, but that's what we have seen all along as a result of the Fed raising rates, hitting the hardest levers balance sheets, meaning those balance sheets that have the most debt. So overall, I still think that the economy is chugging along very nicely here.